Hey everyone, welcome back to your channel, where we break down the strategies of the ultra-wealthy to help you navigate the markets. Today, we're diving into a pattern that's repeated throughout history, the three specific trades that billionaires and legendary investors make right before major market crashes. We're talking about 1929's Great Depression trigger, the Black Monday meltdown of 1987, the 2008 financial crisis, and yes, even signs pointing to a potential shakeup in 2025. These aren't just random moves, they're calculated plays that have turned economic disasters into massive fortunes for the elite. And we'll spotlight big names like Warren Buffett, who embodies timeless wisdom in turbulent times. If you're serious about protecting your portfolio, hit that like button, subscribe, and let's get into it. By the end, you'll know exactly what to watch for. First, a quick history lesson. Market crashes don't happen in a vacuum. They're often preceded by euphoria, overvaluation, and warning signs that only the sharpest eyes spot. In 1929, the Dow Jones plummeted 89% from peak to trough, wiping out trillions in today's dollars. In 1987, Black Monday saw a 22.6% single-day drop, the worst in history. 2008's subprime mortgage meltdown erased 50% of stock values globally. And for 2025? Well, with rising tariffs, geopolitical tensions, and sky-high valuations, experts are sounding alarms. But while the masses panic, billionaires position themselves to profit. So what are these three trades? Let's break them down one by one. Trade number one, convert to cash. Sounds simple, right? But it's all about liquidity when the storm hits. Billionaires pull out of overvalued assets and hoard cash, waiting to buy the dip at bargain prices. This isn't about fear, it's about opportunity. Take 1929. Joseph P. Kennedy, father of JFK and a shrewd investor, sensed the bubble bursting. Months before the crash, he liquidated his stock holdings, converting everything to cash. Legend has it, he got tipped off when even his shoeshine boy was giving stock tips. Classic sign of market mania. Kennedy walked away with $50 million, over $800 million today, while others lost fortunes. He then used that cash to scoop up distressed assets during the Depression, building the Kennedy dynasty. Fast forward to 1987. Paul Tudor Jones, the hedge fund legend, built a huge cash reserve before Black Monday. He'd analyzed historical patterns and predicted the crash in a famous PBS documentary. By staying liquid, he avoided the carnage and pivoted to shorts, which we'll get to later. In 2008, Warren Buffett, the Oracle of Omaha, exemplified this perfectly. Berkshire Hathaway sat on a massive cash pile, over $30 billion before the crisis hit. Buffett didn't panic sell, he waited. Then, during the depths, he invested $5 billion in Goldman Sachs preferred stock with warrants, turning it into a $3 billion profit. Buffett's mantra? Be fearful when others are greedy, and greedy when others are fearful. He builds cash during booms to deploy in busts. As he wrote in his 2008 New York Times op-ed, "A simple rule dictates my buying. Be fearful when others are greedy." Now for 2025, Buffett's been stockpiling cash again. Berkshire's cash reserves hit a record $277 billion in mid-2025. With potential tariff wars under a new administration and the S&P 500 trading at lofty multiples, this could be his play for the next downturn. Economists warn of a topple if markets overheat. Lesson? Cash is king before a crash. It gives you firepower when prices plummet. Trade number two, buy gold or other safe haven assets. When faith in stocks and fiat currency wavers, billionaires flock to timeless stores of value, like gold, which hedges against inflation and uncertainty. Back in 1929, Bernard Baruch, a Wall Street titan and advisor to presidents, shifted heavily into gold and bonds before the crash. He sold stocks in 1928, sensing the speculative frenzy, and preserved his wealth while others evaporated. Gold's price stability helped him thrive post-crash. In 1987, investors like George Soros positioned in gold as volatility spiked. Soros, famous for breaking the Bank of England in 1992, but also active in '87, used safe havens to weather the storm. 2008 saw John Paulson, the hedge fund manager who made $4 billion shorting subprime, also allocate to gold. Post-crash, his fund's gold bets soared as the metal hit record highs amid quantitative easing. Buffett? He's traditionally skeptical of gold, calling it unproductive, but even he bought into Barrick Gold in 2020 during COVID uncertainty, though he sold quickly. His real safe haven? Treasuries and cash equivalents, which act similarly. Looking to 2025, gold prices have been climbing amid inflation fears and geopolitical risks. Billionaires like Ray Dalio advocate all-weather portfolios with gold allocations. If tariffs spark trade wars, gold could be the go-to. Pro tip: consider physical gold, ETFs like GLD, or even Bitcoin as a modern digital gold. But do your due diligence. Trade number 3. Short the market or buy protective puts. This is the aggressive play, betting against overvalued assets to profit from the fall. In 1929, Jesse Livermore, the boy plunger, shorted stocks massively before the crash, making $100 million, over $1.5 billion today. He read the tape like no one else and timed his exits perfectly. 1987 star was Paul Tudor Jones again. He tripled his money by shorting the S&P 500 futures, predicting the crash based on 1929 parallels. His firm made 200% returns that year. 2008's icons, Michael Burry and John Paulson. Burry, portrayed in The Big Short, used credit default swaps to bet against subprime mortgages, netting $100 million personally and $700 million for investors. Paulson shorted mortgage-backed securities, pocketing billions. Buffett doesn't short often, he prefers long-term holds, but he uses options strategically, like selling puts on undervalued stocks. For 2025, watch for increased put buying or short interest in tech-heavy indices. With AI hype potentially bubbling, shorts could pay off if earnings disappoint. But warning, shorting is risky. Unlimited losses if you're wrong. Use inverse ETFs like SQQQ for safer exposure. So, there you have it. The 3 trades: cash up, buy safe havens, and short the froth. From Kennedy in 1929 to Jones in '87, Paulson in '08, and Buffett's evergreen wisdom, these moves have built empires. For 2025, signs like record valuations, tariff threats, and insider selling suggest caution. But remember, this isn't financial advice. Consult a pro. What's your take? Crash coming or bull forever? Drop in the comments. If you learned something, smash that like, share with a friend, and subscribe for more market insights. Until next time, trade smart.